GM. GM. This is daily levels. 24th of Jan, Wednesday. Let's take a look. So, we did get turnaround Tuesday. We finished green on Tuesday. After a full week of selling, you're now going to see today, after a brutal sell-off across all the ETFs for, I think, Thursday, Friday, Tuesday, Wednesday, Thursday, Friday, 6 days, 7 days, really 6 days of selling and a flat day yesterday. I think you're about to see a sustained uptrend in the ETFs. Many reasons for this. Just keeping it really simple. They're oversold, right? They've sold off every day since the launch. Just some basic mean reversion is in order too. If you take something really simple as the top to bottom, the ETF can rally up to retracing half of its dump, and that would take Bitcoin up to probably 45k. It's just the same as it taking up half of this decline, right? And that's not going to happen in one day, but we can go to 44k. There we are. And that would just be a short squeeze, which would take out all of these late shorts that I talked about. These guys are not safe, right? If you're short from here, you're probably fine, probably get a chance to add to your shorts. This is the thing. Smart traders, like smart bears, will be welcoming this. That's why we're bouncing. They'll be covering, closing, taking profit. But they'll be looking to re-add up here if they see a lower high bounce. So it doesn't even have to be bullish for price to go up there. But it's not just that. There's a bunch of stuff happening across the market here with regards to liquidity. So, a couple of things. The PBOC, which is the Reserve Bank in China, People's Bank of China, they have announced rate cuts, essentially stimulating liquidity. So the PBOC is easing, right, supporting the markets, and that's the second biggest economy in the world, behind the US. As you can see here on the Global Liquidity Watch, which is from a couple of days ago, global liquidity levels are at, I believe, all-time highs. Not sure if they were higher in 2020, but I think they're at all-time highs. And stabilized above this level, above the average, right? So they're 169, above the 166 average. And liquidity continues to improve. Liquidity conditions continue to improve, right? So that's all you really need to know from that perspective. It's also being led by the US and China, with tightening happening in England, the Bank of England, and in the ECB, and with Japan being flat. That's usually a sign of what's to come, because the rest of the world tends to follow the US, especially the Western world. So the fact that it's England and Europe against America, I would say it's more likely that England and the ECB start to head more in the direction of the US themselves. You got a bunch of stuff going on. Next week, we have the Fed funds rate, so the Fed meeting. A decent amount of this decline that we had seen, like people will say it's grayscale, it's GBDC, but in reality, there's been a repricing of the Fed interest rate hikes. So if you go on the Fed Watch tool, you can see for January, because markets don't deal with the reality. Markets are forward-looking. So what markets do is they price in what they think is going to happen in future, right? And so if you remember back in December at the Fed meeting, the markets went crazy because basically Powell came out in his meeting and said, we're going to ease, right? We're going to cut rates next year. We're talking about reducing quantitative tightening, which just is basically political speak for we're going to stop the tightening and we're going to go back to easing, which is money printing. I mean, the writing's on the wall. Eventually, they're going to get there. They've also been running down the RRP, the reverse repo, which is a way to add liquidity into the markets. You can find this if you just type in RRP Federal Reserve. You can see how much they have here. Right, so as this declines, money is flowing in to the markets, all else being equal. And so it dipped below 600 billion earlier in January. It's increased again a little bit, but it's still on a decline. It's on a pretty steady path lower. And the target for this is really to get it all the way back down towards zero. At which point then they'll have to look at other ways to stimulate. Right now, this can stimulate the markets. If this money flows out of RRP, it moves into other markets, and it's typically good for risk assets as well as gold and, of course, now crypto. So all of these tools seem to be still pointing towards positive liquidity conditions. And then when you take in the fact that Bitcoin has had a massive sell-off with not a lot of justification other than the market changing its expectations, and then you add in the fact that, yes, obviously, there were sellers exiting GBTC and adding probably extra outflows that was harder for the market to absorb. You're setting up now to a point where there's going to be the perfect conditions for a bounce. So people are going to be bearish. They're always going to think it's going to go down, but this is why you just keep yourself bullish in a bull market and don't overcomplicate it. Because now we've had the question now becomes, what happens when the grayscale selling slows down, which it already has, by the way. Yesterday was one at GBTC since the launch. Obviously, all of the net selling is coming from grayscale. Everyone else has net inflows, so any outflows are coming from GBTC. All the others are adding. They're accumulating. There's more Bitcoin coming in. Obviously, super high volume on day 1 and day 2, and then into last week, we saw steady, consistent selling. Especially Thursday was heavy, Friday was heavy, Monday was heavy, but Tuesday really tailed off. Tuesday wasn't much at all, a little bit on the open, but the volume in general is starting to decline from GBTC. You need to see how this goes, because the expectation is generally that the GBTC ETF, if there's higher volume there, the expectation would be that mostly it's probably going to be outflows and selling, whereas the others, like IBIT, which is BlackRock, the volume that's rising on this, you can see with the flows they report that they are accumulating Bitcoin. So their customers are obviously buying it. So if that GBTC selling slows down, and you've had Bitcoin with a 20% decline, and it's now reclaiming the 40k level, and you see the Fed funds rate, this is one of the things that's been drawing down Bitcoin and also kind of holding back gold a little bit, because Bitcoin and gold are going to be very sensitive to interest rates, especially real rates, which is the Fed funds rate minus CPI, inflation. But what matters is the expectation. So this is the January meeting. So this is the one at the end of this month. It's 97% priced in that they're not going to cut rates this month. I said this back in December, said it in January preview. The Fed are not going to cut rates in January, but the market started to try and price that in last month. So the thing you want to look back at is the probability from the past. So if you look here, current, this is the probability of them not doing anything, which currently is 97%, right? So basically, on the 31st of Jan, the expectation of the market is the Fed are not going to cut rates. They're going to keep them paused. But even as little as a week ago, the odds were lower. Ever so slightly, but lower. But then a month ago, back in December, it was 85%. So if it's gone from 85% to 97%, that means that the odds of the Fed holding rates steady have increased. Meaning, back in December, the market was pricing in about a 15% chance, 15% chance that they would cut rates. And obviously, the sooner they begin to cut rates, the closer we get on that path back to easy money conditions and essentially up only for the markets. But what's been happening since the 22nd of December until now is the odds of that have been getting less and less and less. Right? And the odds of them holding rates steady have been rising. So the market prices that in. But what's more important is March. So the market has always expected March to be the first. But as you can see back here, the odds a month ago of them keeping rates steady was just 12%. So there was an 88% chance priced in by the market a month ago that the Fed would cut rates. Right, you see here that 500 to 525, that would be one cut. That was 75% priced in. Right now that's 50%. So the market has moved significantly lower in its estimation of the Fed cutting rates in March, down to a point now where it's about 50-50, roughly 50-50 of whether they'll cut or hold it steady. And most of that change has come in the past, let's call it 2 or 3 weeks, right? It was since the end of December going into January, we've seen that really tail off. Bitcoin was able to hold up because of the ETF hype, but after that, the market's starting to price that in much more. This isn't a negative. This is actually a great reason for a dip to be bought and for this dip to hold and for a bottom to be in. I wouldn't be surprised if the actual bottom is in. Now, it depends on several things. There's also, which I'll talk more about in a later video, probably next week's weekly outlook, but on I think it's the 29th of January, the Treasury, which is Janet Yellen, so you have two sides to the US in terms of money printing or just policy. You got fiscal policy and monetary policy. Monetary policy is the Fed of the central bank. Fiscal policy is the government, which is led by Janet Yellen in the Treasury, right? There are two ways of printing or reducing money, so easing or tightening. This is a decent thread I've read. I don't agree with all of it, but it makes sense from his logic, right? Talking about game theory, and that's really one of the best ways to view how anyone takes actions, because everything is about incentives. First thing he says, Yellen. So Janet Yellen wants to stay in power. If Biden loses in November, she's gone. Trump is not going to keep her, right? She's a hardcore Democrat. And what you need to see then is, where does the market expect to go if Yellen is going to do what every politician will do, which is what? Protect themselves, right? Look after themselves, watch their own back. That's really what they're doing. That's all they care about. There's no, they don't care about you. They don't care about me.